Okay, that time of year again, isn't it?
Feels like it just ended.
I know. The one that just seems to creep up faster than you expect. Tax season. And for so many of us, it just conjures these images of like piles of paper, endless numbers, maybe a bit of dread.
Oh, definitely dread. It feels like this huge, impenetrable wall sometimes.
Exactly. But what if I told you those forms, those seemingly daunting forms, aren't just a chore? What if they're actually like a blueprint, a detailed map of your financial life?
A map. I like that.
Yeah, a map to understanding, and maybe more importantly, potentially optimizing your whole financial picture. Okay, let's unpack this.
Indeed. And for this deep dive, that's exactly our mission. We want to cut through some of that complexity. We're going to focus on three specific, but honestly incredibly crucial parts of your 2024 Form 1040, Schedules 1, 2, and 3.
Schedules 1, 2, and 3. Got it.
Right. And these aren't just, extra pieces of paper to shuffle around. They're really fundamental. They tell a much broader story about your financial activities, how your income is categorized, what powerful deductions and credits you might actually qualify for, and even other taxes that might apply just to your specific situation.
So it's more than just the main form.
Oh, much more. Understanding these forms is kind of a shortcut to being really well informed. It helps you move beyond just, filing your taxes to actually strategizing, thinking smarter about saving and building a more efficient financial future.
Strategy. I like the sound of that.
Yeah. Our goal here is really to equip you with the knowledge to tackle tax season with, well, more confidence, more clarity. And we'll specifically focus on how these forms relate to things like additions to income, those really game-changing deductions, credits that directly cut your tax bill, and those other taxes that, if you understand them, can help you avoid some nasty surprises.
Less dread, more strategy. That sounds like exactly what we need. All right, so where do we start this journey? Schedule 1.
Let's start with Schedule 1.
Okay, Schedule 1, Form 1040. Officially, it's called Additional Income and Adjustments to Income. And I think for a lot of people, this is where the financial story really gets, well, more interesting than just a basic W-2, right?
Absolutely. It's designed to capture all those other income sources and, crucially, those adjustments that don't quite fit on the main Form 1040.
You might actually be surprised by some of the common things that end up here and how much they can really impact your overall tax liability, not just for this year, but maybe even down the road.
That's a great point. Think of Part 1 of Schedule 1 as the IRS basically saying, okay, we see your W-2 income, but what else did you earn or receive this year?
Right, the what else category.
Exactly. This is where all sorts of other income beyond typical wages gets reported. And importantly, these things can increase your taxable income.
Okay, so what's first on the list?
So right there on line 1, we have taxable refunds, credits, or offsets of state and local income taxes.
Wait, a refund can be taxable? That sounds wrong.
It does seem counterintuitive, doesn't it? But here's the logic, or the reason behind it. If you itemized your deductions in a prior year,
Okay.
and you claimed a deduction for the state and local taxes you paid that year.
Which many people do, if they itemize.
Right. And then in a later year, you receive a refund of some of those taxes you previously deducted. Well, that refund might be considered taxable income in the year you actually get the money.
Ah, I see. So if I deducted, say, $10,000 in state taxes last year, and this year I get a $500 refund from the state.
Then that $500 might be taxable income this year because you already got the benefit of deducting it last year. It's essentially the IRS kind of balancing the books, recapturing a deduction you benefited from, especially if it lowered your federal tax.
Okay, that makes more sense. But I can see how people would get tripped up by that. You get a check from the state, you think, great. And forget about the tax implication later.
Oh, absolutely. It happens all the time. People get these refunds months after filing. Maybe they had a big state tax payment one year, and by the time the refund arrives, the connection to the prior year's itemized deductions is just gone from their mind.
Right. A good reminder to keep solid records.
Definitely. Keep those records. Understand the whole life cycle of your deductions. Okay, moving down to line 2A, alimony received.
Alimony.
Now, this is important. This specifically applies to alimony agreements, divorce, or separation agreements that were made before January 1st, 2019.
Before 2019, why the cutoff?
There was a major tax law change. For agreements executed on or after January 1st, 2019, alimony received is generally not taxable income to the person getting it. And conversely, it's not deductible by the person paying it.
Oh, wow. Big shift.
Huge shift. It simplified things in some ways, basically putting the tax burden on the payer's income rather than splitting it. But for those older agreements, before 2019, alimony received is taxable income. and needs to be reported right here. Line 2B is just there to confirm the date of the original agreement.
Got it. Another case where knowing the specific date is absolutely critical. Okay, what about folks who don't get a W-2? You know, the freelancers, the entrepreneurs, the gig workers.
Ah, yes. For them, line 3, business income or loss, is absolutely fundamental.
This is where their main income goes.
Their net income or loss, yes. If you're self-employed, a freelancer, run a small business, this is where you report that bottom line from your operations. And that number comes directly from Schedule C.
Schedule C, that's the detailed one for business income and expenses, right?
Exactly. You attach Schedule C separately. And listen, this isn't just about reporting income. This line and the Schedule C behind it, this is your power play for tax savings.
Oh, so.
Because every single ordinary and necessary business expense you incur directly reduces your gross business income before it even hits this line on Schedule 1. We're talking home office, supplies, software, travel, professional development, advertising, even a portion of your self-employment taxes, which we'll get to later.
So keeping meticulous records of expenses is key.
It's not just key, it's foundational. Diligent, categorized record keeping throughout the year is paramount. It directly lowers your overall taxable income. It can even potentially shift you into a lower tax bracket, maybe make you eligible for other benefits tied to your income level. It's not just about cutting the tax bill, it's about strategically managing your entire financial profile.
Wow. Okay, so proactive expense tracking is non-negotiable for the self-employed.
It's absolutely non-negotiable. Then let's look at line 5. This is rental real estate, royalties, partnerships, S corporations, trusts, etc.
Sound like passive income territory.
Generally, yes. If you own rental properties, get royalties from, say, a book or invention, or your partner in a business, own shares in an S corp, or are a beneficiary of a trust, the income or loss flows through here. Often you'll get a Schedule K-1 form that tells you what to report.
And these can get complicated, I imagine.
They can be complex, definitely, but they also offer significant opportunities for deductions that sometimes get overlooked. Things like depreciation on rental properties, deducting property management fees, repairs. These details are usually handled on yet another form, Schedule E, which you attach.
So many schedules.
It's a web, but understanding it lets you maximize deductions related to those passive investments. And that can be a really substantial tax-saving opportunity if you manage it right.
Okay. What about line 7, unemployment compensation? Seems straightforward, but maybe not.
It seems straightforward, but here's the critical hidden trap, you might say. Unemployment benefits, while obviously a vital lifeline during tough times,
Absolutely.
they are generally taxable income at the federal level.
Oh, many people might not realize that.
Exactly.
Uh.
And unlike your regular job, where taxes are usually withheld from your paycheck, with unemployment, the withholding isn't always automatic. The burden often falls on you to either request tax withholding from the benefits or to consciously set aside money to cover the taxes later.
So you could get a surprise tax bill in April.
We see it happen all the time. People are already stressed, dealing with job loss, and then, bam, an unexpected tax liability because they weren't managing the tax aspect of those benefits. It's a crucial reminder that even government assistance can count as taxable income.
Good to know. Okay, now let's look at line 8, other income. The list here, 8A through 8Z, it's extensive. It really feels like the IRS cast an incredibly wide net.
You're absolutely right. Line 8, with all its subcategories, really drives home just how broad the definition of income can be for tax purposes. It's a bit of a catch-all.
What are some of the more maybe surprising or interesting ones you see pop up there?
Okay, let's pick a few. Line 8B, gambling.
Winnings from Vegas or the lottery.
Exactly. Lottery wins, casino winnings, sports betting payouts, it's all taxable income. And here's the part that trips people up. You generally have to report all your winnings as income.
Even if you lost more than you won overall.
Yes. You report the gross winnings first. Now, if you itemize your deductions on Schedule A, you can deduct your gambling losses, but only up to the amount of your winnings. You can't deduct a net gambling loss.
So if I win $1,000 but lose $1,500, I report $1,000 income. And if I itemize, I can deduct $1,000 of losses, but not the extra $500 loss.
Precisely. That big win needs to be reported even if you gave it back later. No hiding lottery tickets under the mattress.
Okay, so Lady Luck's visits are taxable even if she doesn't stay long. What else?
Another really important one, line 8C, cancellation of debt.
Forgiven debt. How is that income?
It's a tough one conceptually. But if a lender forgives debt you owe, Say, they settle a credit card balance for less than you owed, or part of a mortgage is forgiven in a foreclosure situation. That forgiven amount can be considered taxable income.
Wow. That feels like adding insult to injury.
It can feel that way. There are some exceptions, important ones, like if you're insolvent, meaning your liabilities exceed your assets, or if the debt is discharged in bankruptcy. But outside of those specific situations, forgiven debt often is taxable income. I remember a client being genuinely shocked by this. It's a critical area, especially if you're negotiating debt settlements.
Definitely something to be aware of. What about more modern stuff? Crypto, NFTs.
Yep, the IRS is catching up. Look at Line 8V. Digital assets received as ordinary income not reported elsewhere.
So getting paid in Bitcoin.
Exactly. If you receive cryptocurrency, NFTs, or other digital assets as payment for services, or maybe as a prize, the fair market value of those assets at the time you receive them counts as ordinary income.
The value when you get it. All right.
Yes. The IRS is making it very clear that digital assets aren't escaping taxation. Understanding the rules here is becoming vital for anyone in that space.
Makes sense. Any simpler examples on line 8?
Sure, there are more mundane ones too, like Line 8 for jury duty pay, or Line 8I for prizes and awards, like that prize money from the local bake-off.
Huh. Even the bake-off winnings.
Potentially, yes. These just show that even small, seemingly minor income sources count. It really highlights just how broad income is in the eyes of the IRS. Basically, if you received economic value, they likely consider it income unless there's a specific exclusion. A comprehensive look is essential.
It really is an incredibly wide net. Okay, let's shift gears. Enough about adding income, let's talk savings. We're moving to part 2 of Schedule 1. I like to call this the good news section.
The good news section, I like that.
This is where we find adjustments to income. Now, these are often called above-the-line deductions. What does that mean exactly?
It means these deductions reduce your income before you calculate your adjusted gross income, or AGI.
And why is lowering AGI so important?
Because your AGI is a critical number. It's used to determine your eligibility for, and sometimes the amount of, many other tax benefits, credits, other deductions, even things like IRA contribution limits. So reducing your AGI with these above-the-line adjustments is incredibly powerful. It's your first major opportunity to lower your tax bill.
Okay, so these are foundational savings. Here's where it gets really interesting. What are some key adjustments people should know about?
Absolutely. Let's dive in. Line 11 is educator expenses.
For teachers?
Yes, for eligible K-12 educators. If they pay out of pocket for unreimbursed classroom supplies, books, professional development courses, things like that, they could deduct up to a certain amount right here.
Even if they don't itemize deductions?
Correct. Even if they take the standard deduction, they could still claim this adjustment. It's a direct reduction of their income. A small, but I think well-deserved break for teachers.
Definitely. What's next?
Line 13, the health savings account HSA deduction. HSAs are, frankly, amazing tools if you're eligible.
I am amazed.
We often call them triple tax advantaged. It's quite remarkable. First, the money you contribute is tax deductible now in the year you contribute. That lowers your AGI right away.
Okay, deduction up front. That's good.
Second, any earnings or interest your money generates inside the HSA grows completely tax-free. No taxes on the growth year after year.
Tax-free growth. Nice.
And third, if you withdraw the money for qualified medical expenses, doctor visits, prescriptions, dental, vision, even things like Medicare premiums and retirement, those withdrawals are also completely tax-free.
Deductible contributions, tax-free growth, tax-free withdrawals for medical. Wow.
Triple threat. It's a fantastic vehicle, not just for current healthcare costs, but also as a powerful long-term savings tool, almost like a supplemental retirement account specifically for health expenses. If you have a high-deductible health plan that makes you eligible for an HSA, it's definitely worth exploring.
That sounds incredibly versatile. What's the biggest, misunderstanding people have about HSAs?
I think many people see it just as a sort of checking account for immediate medical bills. They use it, but they don't necessarily invest the funds inside it or think of it as a long-term investment vehicle. They miss out on that tax-free growth potential over decades, especially if they stay relatively healthy and can let the balance accumulate. That's the real missed opportunity for long-term wealth building.
Got it. Think investment, not just checking. Okay, what about the self-employed folks again? Any adjustments specifically for them?
Oh yes, several crucial ones. Line 15 is the deductible part of self-employment tax.
We mentioned self-employment tax adds to your bill on Schedule 2.
Correct. Self-employed people pay both the employer and the employee halves of Social Security and Medicare taxes.
Yeah.
It's a significant cost. The good news here on Schedule 1 is that you get to deduct 1/2 of what you paid in self-employment tax as an adjustment to your income.
So you pay the tax, but then you get to deduct half of it.
Exactly. It helps offset the burden. It's a really significant deduction for freelancers, independent contractors, small business owners. Reduces their AGI directly.
That's huge. What else for the self-employed?
Lines 16 and 17 are also key. Line 16 is for contributions to self-employed SEP, simple and qualified plans. These are retirement plans specifically for the self-employed, like a SEP IRA or a simple IRA or even a solo 401k. Contributions you make to these plans are deductible here.
Encouraging retirement savings for entrepreneurs.
Absolutely. It allows them to defer taxes on potentially large amounts of income while building their nest egg. And line 17 is the self-employed health insurance deduction.
Health insurance is expensive when you're on your own.
It really is. So if you're self-employed and not eligible for an employer-sponsored health plan elsewhere, like through a spouse's job, you can generally deduct the premiums you paid for medical, dental, and long-term care insurance for yourself, your spouse, and your dependents.
Another major deduction for them.
It's critical, provides crucial relief on those often substantial health insurance costs. Both the retirement plan deduction and this health insurance deduction are vital financial planning tools for business owners.
So for freelancers and small business owners, Schedule 1 Part 2 is just essential.
It's absolutely the bedrock of their tax planning strategy.
Sure.
Okay, another very common one. Line 20, the IRA deduction.
For traditional IRA contributions.
Yes, contributions to a traditional IRA. Whether or not you can deduct those contributions depends on a couple of things. Your income level, and whether you or your spouse are covered by a retirement plan at work. If you're under the income limits or not covered by a work plan, you can often deduct your full contribution.
So it encourages retirement saving for everyone, potentially.
Exactly. It's a very common and accessible way for many people to lower their taxable income now while saving for the future.
And student loans. So many people have those.
Right. Line 21 offers the student loan interest deduction. You can deduct the interest you paid on qualified student loans during the year up to a maximum of $2,500.
$2,500 of interest, okay.
Yes. There are income limitations on this deduction too, so not everyone qualifies for the full amount, but it definitely helps alleviate some of the financial burden of student debt for millions. It's direct tax relief.
Good to know. And alimony.
Just like alimony received, alimony paid on line 19A also has that crucial date restriction. It's only deductible by the payer if the divorce or separation agreement was executed before 2019.
Same rule, just the other side of the transaction.
Precisely. A deduction for the payer, income for the recipient under those older agreements.
Okay. And then, similar to the income section, we have line 24, other adjustments, with another long list, 24A to 24 stunts. It really shows how specific these things can get.
It really does. While, many of these are quite niche, they highlight how the tax code tries to address a vast array of unique circumstances. They show the level of detail involved.
Any interesting examples jump out?
We'll look at line 24. Attorney fees and court costs for actions involving certain unlawful discrimination claims. That's a very specific deduction, acknowledging the expenses someone might incur pursuing justice in those situations.
Wow.
Or line 24J, the housing deduction from Form 25505. This is for U.S. citizens or residents living and working abroad who qualify for the foreign earned income exclusion. It lets them deduct certain housing costs in that foreign country.
So very specialized situations.
Very. But the point is, these adjustments aren't just, obscure lines on a form. If you qualify for any of them, they represent real money back in your pocket by lowering your AGI. It really emphasizes why it's important to know what deductions and adjustments might apply to your life. Understanding these is truly foundational to minimizing your taxable income and setting the stage for more tax efficiency.
What a powerful section. These adjustments really are that first crucial layer of tax savings, bringing down that all-important AGI. Okay, so we've reduced our income. Now let's talk about reducing the actual tax bill.
Ah, the credits.
Yes. This brings us to Schedule 3, Form 1040, titled Additional Credits and Payments. Now, if Schedule 1 was about, say, shrinking the size of the taxable pie,
Good analogy.
Schedule 3 is about taking a direct bite out of the tax itself. And that's a really critical difference, isn't it?
It's a fundamental distinction, and one that cannot be stressed enough. Deductions, like those on Schedule 1, reduce the amount of your income that's subject to tax. So a $100 deduction might save you, say, $12 or $22 or $24, depending on your tax bracket.
Right. It saves you a percentage.
Exactly. But a credit is a dollar-for-dollar reduction of your actual tax liability. A $100 credit saves you the full $100 off the tax you owe. It's a direct hit to the bottom line. Much more powerful dollar for dollar.
Okay, direct reduction. Love it. Now, you mentioned there are different types of credits.
Yes, and this is vital. To really understand and harness these credits, you need to know the difference between non-refundable and refundable credits.
Non-refundable versus refundable. Okay, break that down.
Non-refundable credits, which we find in Part 1 of Schedule 3, can reduce your tax liability all the way down to zero. But that's their limit. If the credit is worth more than the tax you owe, you don't get the excess back as a refund. They can only zero out your tax bill.
So if I owe $500 in tax and have a $700 non-refundable credit, it wipes out the $500 tax, but the extra $200 just disappears.
Essentially, yes, you don't get that extra $200. Now, refundable credits, which are in Part 2, are different. These credits can give you money back, even if you owe no tax to begin with.
Wait, even if I owe zero tax, a refundable credit could mean I get a check.
Absolutely. They can push your tax liability below zero, effectively generating a refund payment from the government.
Wow. Okay, so Part 1 of Schedule 3 helps you get to zero tax, and Part 2 might actually put money in your pocket. Let's dig into those non-refundable ones first in Part 1. Sounds like a treasure trove for cutting down the tax bill.
It really can be. Starting right at the top, line 1 is the foreign tax credit.
For taxes paid to other countries.
Exactly. This is designed to prevent double taxation. If you earn income in another country and paid income tax to that country, and that same income is also subject to U.S. tax, this credit lets you offset your U.S. tax liability by some or all of the foreign taxes you paid.
Makes sense. Avoid paying tax twice on the same money.
Precisely. It's crucial for anyone with international income or investments. Keeps things fair across different tax systems.
Okay, what's next? Line 2.
Line 2 is the credit for child and dependent care expenses. This is a really big one for many working families.
For daycare costs and things like that?
Yes, it's for expenses you paid for the care of a qualifying child under age 13, or perhaps a spouse or dependent who couldn't care for themselves, so that you and your spouse, if you're married, could work or actively look for work. Think daycare, preschool, nannies, even summer day camp sometimes.
That helps offset those costs.
It does. It's a common and really valuable credit that directly helps with the financial burden of caregiving, allowing parents or caregivers to remain in the workforce.
Huge help for families balancing work and care. What about paying for college or job training?
That brings us to line 3, education credits. There are two main federal credits here, the American Opportunity Tax Credit, or AOTC, and the Lifetime Learning Credit, LLC.
AOTC and LLC, what's the difference?
The AOTC is generally more generous but more restricted. It's typically for the first 4 years of post-secondary education for students pursuing a degree, and part of it can even be refundable. The Lifetime Learning Credit is broader. It can be used for undergraduate, graduate, or even courses taken just to acquire or improve job skills, and there's no limit on the number of years you can claim it. But it's non-refundable.
So options depending on the situation.
Right. Both are really critical for students and families paying for higher education. They can offer significant tax savings and make education more accessible, helping to lighten that financial load.
Good incentives. Now, you mentioned a lesser-known one earlier.
Yes, line 4. The Retirement Savings Contributions Credit, often called the Savers Credit. This one is fantastic, but often overlooked.
Who is it for?
It's specifically designed to help low to moderate income individuals save for retirement. If your income is below certain thresholds and you contribute to an IRA, traditional or Roth, 401k, 403b, or similar retirement plan.
You get a credit just for saving.
Yes. You can get a credit for percentage. It could be 10%, 20%, or even up to 50% of the amount you contribute, up to a certain limit. It's basically the government giving you a bonus, a tax credit, for saving for your own future. A true double win.
Wow. Free money for saving. That's incredible. Why isn't this better known?
That's a great question. Maybe because it's targeted at lower income levels, or perhaps it just gets lost among the more common credits. But it's incredibly powerful if you qualify. A real way to supercharge retirement savings.
Definitely something people should check if they meet the income limits. Okay, what about going green? Any credits for that?
Oh yes, the tax code definitely encourages that. Lines 5A and 5B cover clean energy credits for your home.
Like solar panels?
Exactly. Line 5A is the Residential Clean Energy Credit. This is for installing things like solar panels, solar water heaters, wind energy systems, geothermal heat pumps, major renewable energy improvements.
And 5?
Line 5B is the Energy Efficient Home Improvement Credit. This is for making smaller, specific, energy-efficient upgrades, like installing certain high-efficiency windows or doors, adding insulation, or upgrading to qualified furnaces, boilers, or air conditioners.
So incentives for both big and smaller green projects at home?
Right. These credits directly reduce your tax bill, helping to offset the cost of making your home more environmentally friendly and hopefully lowering your energy bills too. Substantial savings potential here.
Great. And the green theme continues with vehicles, right?
It does. Line 6F and 6 meters are for clean vehicle credits. Line 6F is the new clean vehicle credit for buying a new qualifying electric vehicle, or EV.
And 6 meters must be for used EVs.
Correct. Line 6 meters is the credit for previously owned clean vehicles for buying a qualifying used EV. These could be really significant credits, thousands of dollars in some cases.
That could make EVs much more affordable.
It definitely helps. But, and this is a big but, these credits come with very specific and, frankly, somewhat complicated rules.
Oh, like what?
Rules about where the vehicle is assembled, where the battery components came from, the manufacturer's suggested retail price, and importantly, your own income level. The rules can also change, sometimes year to year.
So you really need to do your homework before buying.
Absolutely. Check the latest IRS guidance, check the specific vehicle's eligibility. Often there's a VIN decoder tool. Make sure you qualify based on income. Due diligence is absolutely paramount here to avoid disappointment, or worse, having to repay the credit later, which we'll get to on Schedule 2.
Okay, noted. Devil's in the details on the EV credits. What other non-refundable credits are on Schedule 3?
Well, Line 6 is the adoption credit. This is a very substantial credit designed to help families with the often significant costs associated with adopting a child. Things like adoption fees, court costs, attorney fees, travel expenses.
Recognizing the financial commitment of adoption.
Exactly. It provides really meaningful relief for families growing through adoption. And one more interesting one on Line 6G, the mortgage interest credit.
Wait, isn't mortgage interest a deduction on Schedule A?
Usually, yes. But this is different. This mortgage interest credit is less common. It's typically tied to something called a Mortgage Credit Certificate, or MCC. These are sometimes issued by state or local governments, often to help first-time homebuyers or lower-income borrowers.
So it's a special program.
Yes. If you have an MCC, you can claim a direct credit for a portion of the mortgage interest you paid, which, again, is a dollar-for-dollar reduction of your tax. It's more powerful than the deduction for those who qualify.
Interesting. That distinction between credit and deduction really is key, isn't it?
It's probably the single most important thing to grasp about these schedules. One reduces income, the other directly reduces tax. Huge difference.
Okay, so those are the non-refundable credits, wiping out tax down to 0. Now let's talk about the really exciting ones. Refundable credits in Part 2. These can actually put money back into your pocket, right? Even if you didn't owe any tax.
That's exactly right. These are truly powerful because they can generate a refund or increase your refund amount, regardless of your tax liability before the credit. They represent actual payments back to you from the government in certain circumstances.
So what's the main one here?
Probably the most commonly encountered one is on Line 9, the Net Premium Tax Credit.
Related to health insurance.
Yes, specifically for health insurance purchased through the health insurance marketplace, the ACA exchange. This credit helps make that coverage more affordable. Many people receive advance payments of this credit throughout the year, paid directly to their insurer to lower their monthly premiums.
Right, the subsidies.
Exactly.
Yeah.
Line 9 is where you reconcile the advance payments you received based on your estimated income with the actual credit you qualify for based on your actual income reported on your tax return.
So what happens if the estimate was off?
If you received less advance credit than you actually qualify for, maybe your income ended up lower than expected, you'll get the difference back here as a refundable credit. If you received too much, maybe your income was higher, you might have to repay some or all of it, which we'll see on Schedule 2.
Ah, the reconciliation. Crucial to keep your marketplace info updated then.
Absolutely critical. If your income or household size changes during the year, report it to the marketplace immediately to adjust your advance payments and avoid a big surprise, either a smaller refund or owing money back at tax time. This credit is vital for managing healthcare costs for many families.
Good advice. What's next on the refundable list?
Line 10 is simply amount paid with request for extension to file. Not really a credit, just accounting for money you already sent in. If you filed Form 4868 for an extension.
You usually have to pay what you estimate you owe.
Right. This line just makes sure that payment gets properly applied against your total tax liability when you eventually file the return. prevents double paying.
Okay, straightforward. What about line 11?
Line 11, excess Social Security and Tier 1 RRTA tax withheld. This can happen if you worked for 2 or more employers during the year.
How so?
Well, there's a maximum amount of earnings subject to Social Security tax each year. It changes annually. Each employer will withhold Social Security tax up to that limit. But if your combined earnings from all jobs exceed that annual limit, you'll have collectively paid too much Social Security tax.
Because each employer didn't know about the other.
Exactly. They each withheld up to the max on their portion. This line allows you to claim that excess amount back as a refundable credit. It's your money that was over-withheld, so you get it back.
That's great news for people juggling multiple jobs. Easy to overlook that.
It really is. Definitely something to check if you had more than one W-2 and your total income was over the Social Security wage base for the year.
Okay, what's line 12, the fuel tax credit? Sounds specific.
It is quite niche. Line 12, credit for federal tax on fuels, is primarily for businesses, not individuals typically. It's for claiming back federal excise taxes paid on fuels used for certain specific purposes, like farming or off-highway business use, where the fuel wasn't used for taxable purposes, like driving on public highways.
So not for my regular commute.
No, definitely not for your commute. Important for certain industries like agriculture or construction, but not most taxpayers.
Got it. And line 13 says another other.
Yes, line 13 is other payments or refundable credits. This is the catch-all for any other less common refundable credits that might exist or be enacted. It highlights that the tax code is always evolving. But the key takeaway for Part 2 is clear. These refundable credits are incredibly powerful. They can mean a direct deposit or a bigger refund check landing in your bank account, even if your tax liability was already zero before the credit. They are the most direct way the tax system can put money back into your pocket.
Fantastic. Okay, so we've covered Schedule 1 for income and adjustments and Schedule 3 for those powerful credits reducing our tax. Now, the other side of the coin. What might increase your tax bill beyond the regular calculation?
Right. That brings us to Schedule 2, Form 1040, titled Additional Taxes.
The flip side. If Schedule 3 was about cutting the tax, Schedule 2 is about things that might add to it.
Precisely. Think of it as the counterpoint. This is where certain other taxes get reported or where you might have to repay benefits you received previously. Understanding this schedule helps you avoid unpleasant surprises and ensures you're meeting all your obligations. It's where special circumstances can unexpectedly increase what you owe.
So ignorance here could definitely cost you.
It certainly could. These additional or other taxes often apply in very specific situations. It doesn't necessarily mean you did anything wrong in your planning, but rather that certain rules apply to your unique financial activities, or as I said, a prior tax benefit needs to be reconciled.
Okay, so what's in Part 1 of Schedule 2, additions to tax?
Part I often deals with repayments of credits received in advance. We already hinted at this. Line 1A is the excess advance premium tax credit repayment.
The flip side of the refundable credit on Schedule 3.
Exactly. If you receive too much advance premium tax credit for your marketplace health insurance during the year, perhaps your income ended up higher than you estimated, or your family size changed. You'll likely have to repay some or all of that excess amount here. It gets added directly to your tax liability.
Ouch. Reinforces the need to update the marketplace.
Absolutely critical. Report those life changes, income increases, marriage, divorce, new job immediately to avoid this repayment shock.
Okay. And you mentioned the clean vehicle credits could come back to bite you here too.
They certainly can. Lines 1B and 1C are for the repayment of new clean vehicle credits and repayment of previously owned clean vehicle credits.
When would you have to repay those?
This typically applies if you took advantage of the option to transfer the credit to the dealer when you bought the car, getting an immediate discount. But then, maybe you didn't meet the income requirements after all, or you resell the vehicle too soon, or maybe the vehicle itself is later found not to meet the manufacturing requirements. If the conditions aren't met, you might have to pay back the credit you received up front via the dealer.
So that upfront benefit comes with strings attached.
Big strings. The tax implication here is really about avoiding repayment. It just hammers home the importance of making absolutely sure the vehicle, the manufacturer, and your personal circumstances meet all the requirements, not just at the moment you buy it, but potentially for a few years afterward, depending on the specific rule. Due diligence is key to avoid this nasty surprise repayment.
Got it. Thorough homework needed for EVs. Okay. What's line 2? The alternative minimum tax, AMT.
The AMT.
Yeah. You know, I have to admit, when I first looked at this line, the AMT always felt like this elusive, almost mythical beast in the tax code that only affects a tiny sliver of the ultra-wealthy population, like something most people don't need to worry about. But I've heard stories of it unexpectedly tripping up people who aren't even super wealthy. Can you maybe pull back the curtain on the AMT and really demystify who it actually affects and why it catches people off guard sometimes?
That's a fantastic question, and you've hit on a common perception and misconception. The alternative minimum tax is a separate parallel tax system. You're right about its original intent. It was designed decades ago to ensure that higher income individuals who might have been using a lot of deductions, exclusions, and loopholes to significantly reduce or even eliminate their regular tax liability still paid at least a minimum amount of tax.
So a backstop for fairness originally.
Exactly. But where it catches people off guard is that the higher income threshold hasn't always kept pace perfectly with inflation, and certain items are treated differently under AMT rules than regular tax rules. So it's not just for the Bill Gateses of the world anymore, although the Tax Cuts and Jobs Act of 2017 did significantly increase the AMT exemption amounts, making fewer people subject to it than before.
So who might get hit by it now, even if they aren't ultra wealthy?
It can potentially affect individuals who have certain specific financial situations. For example, exercising a large number of incentive stock options, or ISOs, is a classic AMT trigger.
No.
Also, having very high state and local tax deductions used to be a major trigger, though the current $10,000 SAL cap has reduced that impact significantly for many. Other factors could include having large amounts of certain tax-exempt interest or significant miscellaneous itemized deductions if those ever come back.
Incentive stock options, that's a big one for people in tech sometimes.
A very big one. Essentially, if your income combined with these certain tax preference items or adjustments that are treated differently under AMT pushes you over the AMT exemption threshold, you have to calculate your tax liability twice, once using the regular tax rules and once using the AMT rules on Form 6251.
And you pay whichever is higher.
You pay the higher of the two. If the AMT calculation results in a higher tax than your regular tax, the difference is reported here on Schedule 2, Line 2, and added to your total tax bill. So while less common now for many middle-income folks, it can still be an unwelcome surprise, especially if you have those specific triggers like ISOs. It's definitely something to be aware of if your finances involve those elements.
Okay, that definitely demystifies it a bit. Still complex, but I see how it's not just about overall income level. Good to know. All right, let's move to Part 2 of Schedule 2. Other taxes, what kind of things land here?
Part 2 covers additional taxes that apply based on specific activities or circumstances, often related to employment or savings accounts. Line 4 is a big one we've touched on. Self-employment tax.
Right, this Social Security and Medicare for freelancers and business owners.
Exactly. This is where the actual calculated amount of that tax goes. Remember, they pay both the employer and employee portions. We saw in Schedule 1 that they get to deduct half of this amount.
Right, as an adjustment to income.
But the full tax liability is calculated using Schedule SE and reported right here on Schedule 2. It's often a very significant number for self-employed individuals.
Makes sense. What's line 5?
Line 5 is Social Security and Medicare tax on unreported tip income. This is specifically for people in service industries, restaurant servers, bartenders, hairdressers, etc., who received tips but didn't report all of them to their employer. If the employer didn't withhold Social Security and Medicare on those unreported tips, the employee is responsible for paying those taxes themselves, right here, usually using Form 42137.
So ensuring taxes get paid on all tip income.
Correct. It's a compliance measure.
Okay. Now, what about those scary penalties on retirement accounts you hear about? Taking money out too early?
Yes. That falls under Line 8. Additional tax on IRAs or other tax-favored accounts. This is a common one that catches people.
What triggers this tax?
Two main culprits usually. First, taking a withdrawal from a traditional IRA, 401k, or similar retirement plan before you reach age 59 and a half, unless you qualify for a specific exception, like disability, certain medical expenses, first-time home purchase up to a limit, etc. If you take an early withdrawal without an exception, there's typically a 10% additional tax penalty on top of the regular income tax.
Ouch. 10% penalty.
It's meant to discourage people from tapping retirement funds early. The second main trigger is failing to take your required minimum distributions, or RMDs.
Your RMDs.
Yes. Once you reach a certain age, currently 73 for most people, you generally have to start taking withdrawals from your traditional retirement accounts each year. The amount is based on your account balance and life expectancy. If you fail to take the required RMD amount by the deadline,
There's a penalty.
there used to be a very stiff 50% penalty. It's recently been reduced, but it's still a significant penalty, currently 25%, potentially reduced to 10% if corrected promptly, on the amount you should have withdrawn but didn't. I knew someone who simply forgot about an old 401k from a previous job, missed their first RMD, and got hit with that penalty. It was painful.
Wow. So the tax implication here is clear. Know the rules, understand withdrawal rules before 59 and a half, and definitely stay on top of your RMGs once you reach that age.
Absolutely. Patience and careful planning are crucial for retirement accounts to avoid these additional taxes. They're designed to enforce the retirement aspect of these savings vehicles.
Makes sense. Okay, what about line 9, household employment taxes? Who does that apply to?
This applies if you hire someone to do household work, and that person is considered your employee, not an independent contractor. Think nannies, senior caregivers, housekeepers, if you control what work they do and how they do it.
If you pay them directly.
Yes. If you pay a household employee cash wages above a certain threshold for the year, it's around $2,700 for 2024, you generally become responsible for withholding and paying their Social Security and Medicare taxes, and potentially federal unemployment tax as well. You report and pay these taxes using Schedule H, and the total gets added here on Schedule 2.
So if you hire help around the house, you might be an employer with tax duties.
You might be. It's important to understand the distinction between an employee and an independent contractor in that context.
Good point. Line 10 seems old. Repayment of first-time homebuyer credit.
It is getting less common, yes. This refers to a specific credit that was available mainly in 2008 and 2009. If you claimed that credit back then, there was a requirement to pay it back over 15 years, or potentially sooner if you sold the home or stopped using it as your main residence within a certain period.
Ah, so a long tail on that old credit.
Exactly. It serves as a good historical reminder that tax benefits, especially credits, can sometimes come with long-term obligations or repayment requirements if conditions change. Always read the fine print.
Good lesson. Now, lines 11 and 12. You mentioned these often hit higher earners.
That's generally true. Line 11 is the additional Medicare tax, and line 12 is the net investment income tax, or NIIT.
What are
The
they?
additional Medicare tax is an extra 0.9% tax on wages, self-employment income, and railroad retirement income above certain thresholds. $200,000 for single filers, $250,000 for married filing jointly in 2024. The net investment income tax is a 3.8% tax on the lesser of your net investment income, like interest, dividends, capital gains, rental income, or the amount your modified adjusted gross income exceeds similar thresholds, $200K single, $250K MFJ.
So extra taxes on earned income and investment income for those above the threshold.
Correct. They were introduced as part of healthcare reform to help fund Medicare and the Affordable Care Act. For higher income earners, these can add significantly to their overall tax burden and definitely require careful planning, especially around investment, income timing, and strategies.
Okay. And then, inevitably, line 17 is other additional taxes, A to Z, more niche items.
Extremely niche, many of them. But they underscore the incredible specificity and breadth of the tax code. It tries to cover almost every conceivable financial transaction or situation.
Any examples just to illustrate?
Sure. Line 17A is recapture of other credits. This is a general line indicating you might have to pay back part of a credit you claimed in a prior year because something happened that disqualified you later. Maybe you claimed an energy credit but then sold the property too soon. Line 17C, 17E, 17F relate to additional tax on HS Archer MSL Medicare Advantage MSA distributions. Similar to the IRA penalty, this applies if you take money out of these health savings accounts for something other than a qualified medical expense.
So penalties for misusing health accounts.
Right. Or way down on 17K, you have tax on golden parachute payments. That's a very specific tax on excessively large payments made to executives if a company changes ownership.
Definitely specialized.
Very. But the listener connection here is that while many of these might seem obscure and unlikely to apply to you, they demonstrate how very specific financial actions can trigger additional tax liabilities. Being aware that these kinds of rules exist can help you proactively structure transactions or manage accounts to avoid triggering them, or at least understand why an additional tax might apply to your unique situation. It's all about preventing those unwelcome surprises come tax time.
Absolutely. Okay, wow. We have really dissected Schedules 1, 2, and 3. We've gone through additional income, adjustments that lower that income, credits that slash the tax bill, and other taxes that can add to it. Let's try to bring this all together now. How do these three schedules connect the dots and feed into the bigger picture of your Form 1040? What does this all mean in the grand scheme of things?
That's the perfect way to frame it. It means each schedule plays a really distinct, yet completely interconnected role in painting the full, accurate picture of your financial year for tax purposes. Think of it like this.
Yep.
Schedule 1. Additional income and adjustments. It expands your income story beyond just your basic wages. It captures everything else you earned, business profits, investment income snippets, maybe even that lottery win. But crucially, it also gives you those powerful above-the-line adjustments, the deductions for HSA contributions, student loan interest, self-employment tax, educator expenses. These are your first line of defense, strategically lowering your adjusted gross income, your AGI. And as we said, lowering AGI is fundamental because it can unlock eligibility for so many other benefits later on. It sets the foundation.
Right. Foundation is Schedule 1, AGI is key.
Exactly.
Yeah.
Then you move to Schedule 3, additional credits and payments. This is where the direct tax savings happen. You've got the non-refundable credits, in part, Obamacare, things like the Child and Dependent Care Credit, education credits, clean energy credits that directly chip away at your tax liability, potentially down to zero. And then you have the powerhouse refundable credits in Part 2, the premium tax credit reconciliation, excess Social Security tax paid, which can actually put money back into your pocket, generating or increasing your refund. These credits are the direct dollar-for-dollar reduction of your tax bill. They offer really significant saving opportunities, the tactical moves on your financial map, maybe.
Love it. Tactical moves. Okay, so Schwan sets the base, Schwan cuts the tax. What about Schwen 2?
Schedule 2, additional taxes, is the necessary counterweight. It ensures compliance and addresses those other taxes and potential repayments. It captures things like self-employment tax, penalties on early IRA withdrawals, repayment of excess advanced premium tax credits, or maybe that AMT calculation. Understanding Schedule 2 helps you avoid unexpected shocks that increase your tax bill. It highlights the potential pitfalls or special obligations based on your specific circumstances. It helps you navigate the potential detours, maybe.
Foundation, tactical moves, and navigating detours. I like that. So by really understanding these 3 schedules, you're not just like passively filling out forms anymore.
Not at all.
You become an active participant, right? You're actually managing your tax liability, taking control of your financial story.
That's the goal. It's about leveraging the rules to your advantage, understanding the narrative your numbers tell, and then proactively shaping that narrative throughout the year, not just when you file.
It transforms tax time from just a chore into maybe an opportunity.
It absolutely can. The tax code, yes, it's complex, no doubt about it, but it is navigable. And these schedules 1, 2, and 3, they're fantastic examples of how your specific life events, having kids, going back to school, starting a business, investing, even making eco-friendly choices can directly impact your bottom line tax outcome. Knowledge really is most valuable when you understand it and can apply it. And there's always more to learn, different perspectives, always enrich that understanding. It's about empowering yourself with that clarity.
What a fantastic journey through these forms. It really does make them seem less daunting and more like tools we can use. So as you, our listener, reflect on your own financial journey, maybe consider this. How might a deeper understanding of these specific forms, Schedule 1 income and adjustments, Schedule 3 credits, Schedule 2 other taxes, how might that change your approach to financial decisions throughout the coming year? Think about buying a car, saving for retirement, managing health expenses, starting that side hustle. Thinking about these tax implications proactively, not just in April, can truly transform how you manage your money. It can turn that potentially dreaded tax season into a genuine opportunity for strategic financial growth